Hello, everybody. I think we are now live, and probably people will start joining now. Perfect. So, thank you, everybody who's joining. We'll have a very interesting conversation in the next hour. We're going to talk about innovation to address Latin America missing middle financing gap. And we have great set of people invited here today to talk about that. We have Caroline Han from MCE Social Capital, Justin Schwartz from Impacto Capital, and Carolina Lobo Guerrero from Viwala. So before we get started in our conversation, I just want to introduce myself first. My name is Natalie Vergara, and I'm the head of platform at Mercy Corps Ventures. We're an impact investment fund focusing on startups in early stage startups that are building business models that can drive the resilience of individuals and communities in emerging markets. And I'm super excited to be here today, joined by these amazing colleagues that I have here today. So I just want to give 1 minute to each one of you to introduce yourself, to just mainly like your name, your organization, your role, and a one-liner of what is it that your organizations do. And then we'll have the opportunity later during the conversation to get a bit more in dive of what is this missing middle financing gap and how each of your organizations is addressing it. So I'll first give the floor to Caroline. Caroline, if you can just introduce yourself.
Absolutely. Thank you, Natalie. Hello, everyone. My name is Carolyn Hahn, and I am a portfolio manager with MCE Social Capital. So MCE is an impact investor that focuses on a variety of emerging markets around the world. We provide debt capital to SMEs across a variety of sectors, including agriculture, water sanitation, renewable energy, and financial service providers. My role at MCE specifically covers a couple of different regions, including Latin America, of course. And as a portfolio manager, I work on all aspects of a deal, including sourcing, structuring, due diligence, negotiations, and also post-investment management. So thanks, Natalie.
Yeah, busy schedule then, like if you're doing all those activities, Caroline.
Very busy.
Perfect. I'll give the floor now to Justin. Justin, can you introduce yourself, please?
Thanks, Natalie. Great to be here. Thanks for everyone who's listening. My name is Justin Schwartz. I'm managing partner of Impacto Capital. Impacto Capital is an impact investing fund focused on early stage impact startups in the Andean region of South America. We're based in Ecuador, our team, and we're focused on, we'll get into more, I'm sure, of what we're doing, but we're focused on really filling the missing middle gap in access to capital for early stage impact companies in the region.
Great, thank you, Justin. And now moving into Caro. Carolina, can you introduce, I'll say Caroline and Caro for you to know the cues. So Caro, can you introduce yourself?
Of course, thank you, Natalie. My name is Carolina Lobo Guerrero, and I am the CFO of Viwala. I want to start by thanking everyone who's joining us today, this morning, this afternoon, wherever you are. And a little bit about Viwala. Viwala is a financial mechanism. We provide debt to missing middle entrepreneurs, specifically in Mexico. We fund small tickets for women-led entrepreneurs and entrepreneurs who are providing social and environmental impact. We are growing to more of Latin America, Colombia, Ecuador, and specifically the Mesoamerican Reef region. And I'm guessing later today we'll be able to explore more of what we do, how we do it, and particularly how we impact the missing middle. Thanks, Nat.
Perfect. Thank you. And yeah, thank you everyone who's joining. We're not sure yet if we can see how many people are here, but please go ahead. Like if you have any questions or comments, don't hesitate to put them in the comments box and we'll try to address any of your comments or questions during our conversation. So let's get started. As I was saying, like the title of our conversation is innovation to address Latin America missing middle financing gap. And just a quick intro to make sure like everyone that's listening in it's aligned to what do we refer to as the missing middle. So we have information according to the World Bank that small and medium-sized enterprises, or what is known normally as SMEs, like really represent more than 95% of the registered firms worldwide. And they also account to more than 60% of job generation and contribute to roughly 35% of gross domestic product in many emerging markets. But the problem is that they are only receiving around 12% of total credit that is issued in these markets. So there's clearly a credit cap for these SMEs, and estimates place this at about $1 trillion. So basically, all these companies that are doing this amazing job in terms of economic generation, job generation, and as Caroline, Justin, and Cara were saying, to solving present social and economic challenges, they are not getting access to the finance they need to grow and support the scale of their businesses. And so my first question to each of you, it's basically why? Why is it so hard to provide companies, be there SMEs or be there startups that are in this space of accessing financing between $50,000 and $1 million? And you can argue with me if that's the correct space to call it the missing middle. But why is it so hard to provide appropriate financing to these companies? And I want to go ahead and start with Justin.
Unfortunately, there's a lot of challenges in providing capital to these companies. I think I'll sort of group them into two categories. One are the challenges of investing in the companies themselves, which include the fact that these are companies at that size are riskier, often have less operating history, or a business model that hasn't been completely established. There often is a lot of informality in these companies and in how they're run at an administrative level, financial level, and those sorts of characteristics of the business itself. There's often challenges with cash flow from these companies. Those sort of characteristics of the business itself make them riskier investments in some cases, not always. And I think some of the work that our organizations are doing are trying to show that, but they're considered, let's say, riskier investments in terms of the characteristics of the companies themselves. There's also some really structural challenges on the financing side. And this has to do with how financing vehicles are structured, whether it be funds, or other type of vehicles, nonprofits, or financial institutions like Biwala. Whatever the structure, there's a lot of challenges in how the cost of due diligence for these sorts of companies, and which can be very high relative to the size of the tickets that are being invested. That creates challenges. There's also many incentives that push fund managers towards larger fund sizes and larger ticket sizes, which leave these kinds of companies out. And I think there's also challenges in terms of what's the right type of capital for these companies, where the typical structure of venture capital investing often doesn't work for various reasons. Banks don't necessarily respond to their needs with very rigid debt and collateral requirements. So there's challenges there are a lot of challenges to investing in these sorts of companies. You need creativity and innovation to make it work.
I like it how you frame it. So basically, just to give it back to Caroline and Caro, what you're saying, like we have challenges on the demand of the capital, mainly saying like these SMEs are more riskier, more complicated, the business models, and also all the sources of capital. Like how do we provide the right capital to this type of SMEs, and particularly talking about the ticket size that we're talking about. So Caroline, I want to like give it up to you. Like, do you agree with this challenge? Do you see other challenges? And can you also like let me know if you agree like with this range of missing middle between 50K and $1 million, or how do you see it, the range of capital?
I definitely agree with everything that Justin has mentioned. I think on top of that, a couple of difficulties with investing in the missing middle is also a lot of these companies tend to lack proper governance. It's a lot of times family driven businesses, there's a key person there. It's one person, one man, one woman show. And they oftentimes lead to key person risk and also unbalanced decision-making structures. The other thing that we'd like to mention is also on finding, a lot of companies struggle with finding the right balance between growth and profitability. Sometimes they might be growing too fast, pressured by some certain types of equity investors, but other times they are trying to protect their profitability too much, but then not putting in enough resources to grow. And these things, it's hard to cater to find the right investor who is willing to, who works with you at the right stage when you're still trying to find this balance. And sorry, Natalie, remind me again what the second
my last question was, do you agree with the range of 50K to 1 million, or how do you define it?
Yeah, I think I do. Depending on the market, it can change a little bit, obviously. Sometimes in certain markets, it's only up to about maybe 500K is where the missing middle is. And then above that, you can find a lot of capital. But generally speaking, I think with MCE's size between 100K up to 1 to 2 million, we find that there is a lot of demand and a lot of need in that missing middle part.
Perfect. Thank you, Caroline. So Cara, just to confirm, on your side, how do you see the range of, like, in general, the missing middle before going to Viwala? Like, do you agree also with Caroline, like between more like 100 and 1 to 2 million, or where do you see it? And if there's any other challenge you would like to add to what Justin and Caroline had said, why is it so hard to provide appropriate financing to these companies?
Of course. Well, from our end, we see the missing middle as a little bit before what MCE and perhaps Impacto see as the missing middle. So our ticket sizes are between 15 to 500K, 500K being the largest range we are seeing. And I do agree with Caroline and Justin on all of the current factors that the missing middle currently face, but I would want to add the credit scoring. So traditional credit scoring usually has a bias against this type of companies because, as Justin said, they're assessed as too risky, or as Caroline said, they do not have the structured financial accounting practices that usually like VCs or traditional banking sector would have. But as well, we see many of them do not have collateral to provide for debt funding, and they have no credit history. So about 84% of the companies that come to us, it's the first time they're going for a loan. And this creates a very interesting scenario where they want to receive the credit, they cannot receive it. And this creates a cycle where they cannot access funding because of how they are structured, because no one else is willing to give them funding. And therefore they are not able to access additional funding in the future. But again, our ticket sizes are 15K, but that is very specific to Mexico.
Okay, so perfect. I love it that you already just jumped into next questions, and I will just follow up with you for you to clarify. So what's basically Viwala doing to address this challenge? And can you, you already mentioned ticket size, country, and like what type of instrument are you using to provide these companies that need this financing? So talk us a bit more about what Viwala is doing.
Of course. So Viwala currently provides only debt. It is short-term debt between 24 and 36 months. And it is provided to the missing middle. The companies have to be either women-led or have a social and environmental impact. And we do so through 3 to 4 different instruments. The first is the fixed payment instrument. Basically, each month you have to pay a certain amount of capital and interest. One is revenue-based, that you pay according to your income at a specific point of time. And then we've developed what we call pay for impact, which is more innovative in the sense that we give you a set interest rate and we set some sort of impact metrics that you have to achieve. As you start to achieve those metrics, the interest rate is reduced to a certain amount. But all our vehicles are debt instruments and the maximum term is 36 months.
Okay, so 36 months debt, either like traditional debt, revenue-based, or impact, pay for impact, what do you call it? Love that one. Great. and now operating in Mexico.
Correct. We are operating mostly in Mexico, and we have one program which does Belize, Honduras, and Guatemala. And in this program, it's every company that has an interest in saving the Mesoamerican reef. So that can be fisheries, that can be hotels, anything ecotourism, but that is specific to that region as well.
Great. Caroline, can you tell us a bit more about what MCE is doing? Like, again, in terms of ticket size, instrument, geographies, and the type of businesses that you are providing financing to.
Yeah, absolutely. So with MCs, I mentioned we provide flexible debt of between, let's say, about $100,000 up to $2 million to our SME partners. And these terms range from about 10 months up to 3 years. Structure-wise, we do a lot of working capital financing that is based off of cash flows that you generate. So really, we don't ask companies to repay us when they don't have any cash flows available, but really it's for example, if agriculture companies have a harvest season, our payments come after the harvest. We also are able to provide CapEx debt and other types of term debt as well, but really the structuring and trade finance debt, but the structuring is really looking at cash flows and needs of the company to make sure it works and it's the right fit. In terms of countries, we're a little bit all over the place in LATAM. So we're in Central America, well, let's say Northern Central America. We have Mexico, Guatemala, Honduras, El Salvador, Nicaragua, and Costa Rica. And then in South America, we are in Bolivia, Colombia, Ecuador, and Peru. And we also have Haiti as well. That's part of the region.
Can imagine how you operate in Haiti. So follow-up question will be that on that one later on. And Justin, talk us about Impacto Capital. So again, like instrument, ticket size, geographies, characteristics in general.
Sure. So the brief story on Impacto Capital is that it was born out of a large organization, Impacto, which has we've been working for 8 years in the entrepreneurial ecosystem in Latin America with an accelerator program and other programs. And I think that's sort of important context because the design of the fund really came out of what we see as the gaps in the access to capital and kind of the needs of the entrepreneurs, social entrepreneurs, specifically in the region. So Impacto Capital is as I mentioned, focused on the Andean region of South America. So we invest in Colombia, Ecuador, Peru, Bolivia, and Chile. We focus on 4 verticals, which are health, education, agro-industry, and food supply chains, and environmental solutions or clean tech and climate tech. And our tickets are between $50,000 and $200,000. And we are big believers in mezzanine instruments, so revenue-based financing, which Gato mentioned, is our primary instrument, revenue-based loans, where entrepreneurs pay us a percentage of their revenue, which we see as the importance of flexibility for entrepreneurs in the missing middle, where traditional debt instruments sometimes can be a challenge, is sort of what has driven us to that, and also non-dilutive capital, which is often difficult to find. So that's where we're focused.
Perfect. This is great. So basically, you're all doing some sort of debt, and there's a lot of flexibility in there, and there are different things like trying out. So yeah, maybe like my next question would be like, yeah, why this? So basically, when we're talking about these companies and the challenges that they're facing, and Justin was just mentioning, like trying to really understand the companies and what are their needs and what do they operate. What do you feel MCE, Biwala, and Impacto Capital feel that the type of instruments that you are using like really addresses the challenges that these companies face? And I will leave it open to if anyone wants to jump in before me calling names.
I can go first. Just from MCE's perspective, as I mentioned, cash flows is a really big thing because we don't offer, the mezzanine debt type products. We really want to be conscious of the fact that we don't want to over in debt any of our partner companies. And so looking for cash flows, making sure that, where we have payments coming in makes sense for the structure of the business and how the business revenues and cash flows come throughout a year. And the other thing we also do provide is grace periods on the principal, which means that companies usually have a little bit of time. If it's a longer term loan, it might be maybe a year of grace period before they start repaying principals, to let them fully use the funding and to help them grow their business even more before they even start repaying us. So from our point of view, it's making sure that our structuring adapts to the business needs.
Okay, so basically you take it on a case-by-case basis in terms of the business to really see if the instrument adapts to them, right?
Absolutely. There's no one-size-fits-all structure from this type of investing.
Right. Kara, you don't want to share Biwala's approach in terms of like why you came up with these 3 instruments?
Of course. So at Viwala, we start what we call like impact labs, and we try different products. We assess about 300 companies per day just to see what is the ideal product for each company, each sector, each revenue cash flow. And we've seen that the most complex part is them being able to repay the interest rate that is currently charged at Mexico. So just to give a little bit of background of what we see in Mexico, this type of companies, SMEs, women-led companies, in the missing middle between looking for tickets of 15 to 50K more or less, are seeing interest rates between 40 to 80%. Those interest rates mean that about 42% of the companies don't make it to the second year of operations. So what we try to do is take blended finance, philanthropic finance, like lenient capital, lenient equity, and just create instruments that result in interest rates that these companies are able to pay back. And that's the reason for the 3 products that we're developing, are products that assess the needs of the companies at that specific moment in time, and that give them the possibility to repay, grow their impact, and grow the company in general. So that's a little bit about how Viwala was born, where it's coming from, and the gaps that we've seen specifically in the Mexican market that we're trying to solve. And to add just a little bit of that, I can see Diana has a question of how we measure that impact, who sets those impact metrics for the pay for impact loans. And that basically, we hire an external consultant who is very good at knowing the specific industry and could set those impact metrics for them. So it is not that we set random impact metrics for every single company, but for every company in a sector who's trying to solve something particular, we have an expert to set those impact metrics so that it is done according to what the company is working for in relation to the company. And it's not just impact metrics that are outside of the capabilities of the company. More specifically, we are doing this for LGBTQ-led companies. We have an expert in the sector, and all the impact metrics are related to LGBTQ inclusion in the company. So we do that with every single sector. And I think that's it.
Thank you. No, that's super insightful. So I'll ask you a follow-up question later on the blended finance and the type of, and I think this is related to also what Sebastian in the chat was asking. So that's great. I just want to wrap up also these round of questions. Like, yeah, Justin, anything to add on how you came up with this revenue-based type of financing for these companies?
Yeah, I mean, so we're working in there's different kind of companies in the missing middle, and we are more on the startup sides of things. And the default in for a lot of entrepreneurs with startups, whether they be impact startups or more traditional startups, is raising venture capital. And you really need 2 key things as a company to be able to raise venture capital. One is you have to have exponential growth, and 2, you need to be able to have an exit. Want to, and have a company that has the characteristics to have an exit. And we work with a lot of companies, and I think impact-driven companies tend to struggle more with those requirements because they have a different mindset. They might we talk a lot about unicorns versus zebras. It's zebra companies that have this balance, maybe a little bit slower growth, more focused on profitability and including all their stakeholders. And those kinds of companies often have trouble raising venture capital. So that's sort of that's an important factor in why we chose the instrument. On the other side of things, there's a lot of companies at this stage, as we talked about, they have a lot of ups and downs, and they need that flexibility. And we've heard about flexibility, I think, from all three of us. And so the flexibility of a revenue-based loan as opposed to a fixed interest loan for us really, and for the companies we work with, really makes a lot of sense. It provides flexibility for the entrepreneur. It aligns also the interests and the incentives for us as a fund, so that we are incentivized to help the entrepreneur to grow, because there's benefits on both sides. And I think having investments with structured exits is really key in the Andean region where we're operating, where equity investments often have that challenge of what's the exit, which leads to conflicts and between entrepreneurs and investors, and sometimes impact gets lost in the path. So that's sort of the factors that have driven us to revenue-based loans as our investment instrument.
Great. And I love that you started to talk a bit more about the companies that you're looking for, like that are these companies that have a sustainable path to growth, and they're not necessary to be the next unicorns that for these type of financing. So before moving to the sources of capital, I would like to also ask all of you, what are the companies that you're looking for? So mainly my question is, one, what type of companies do you fund with these instruments? If you can grip up overall characteristics of these companies. I think you already mentioned a bit of the sectors and the tickets, but just the overall characteristics. And second, how do you evaluate these companies? Because again, that's another big challenge when you're making small ticket sizes. It's not like you have the time or the money to invest in due diligence, a lot of resources. If you're mainly placing a 50K, 1,000 investments, you have to be very lean. So I'm curious about how do you each do it? What are you looking for in these companies, and how do you evaluate that these companies meet the criteria that you're looking for in a lean and effective way? Justin, I'll come back to you just because you were speaking.
Sure. So I'll talk a little bit about our criteria. So we are looking for companies that have generally our sweet spot is between $100,000 and $2 million in annual revenue. Really consistent with the missing middle discussion that we've been having. We're looking for innovation and differentiation, regional business models that can scale regionally and that have impact at their core. So that kind of sounds a little bit abstract. I'll give a few examples, and we're a new fund, so we have yet to close investments, but just based on kind of the kinds of companies we're looking at solar. Companies focused on solar energy. We're looking at companies that are innovating in health, with using technology to help cancer clinics operate more efficiently and save more lives. Companies in education with education platforms that allow people who wouldn't have access to education, vulnerable populations. The heavy focus on women who have access to continuing education. So hopefully that helps the audience get a little bit of a sense of the kinds of companies that we're looking for. In terms of the second question, that's definitely a challenge. And the due diligence, people often say in the investing world that it requires the same amount of due diligence to write a $100,000 check as it does to write a $100 million check. And that means it's a challenge to make the make the math work for smaller funds. So we kind of have a couple of things that we're doing to innovate there. One is that, as I mentioned, Impacto Capital it was born in a spin out of Impacto, an organization that has an accelerator, which provides a lot of pipeline for us, and a team that runs that accelerator and mentors the startups and can provide post-investment support. So we benefit a lot from that structure. We also have grant funding from the Inter-American Development Bank that supports a portion of the operating costs of the fund, which is really key, and also kind of in this blended capital sense, although our capital isn't blended, our investment capital isn't blended, but having operating grants is really key for us. And then just kind of having a lean mindset, I think is really important. So it's not easy, but you need to innovate to make it work.
Great. Thank you. Caroline, how about you? How do you do it? How do you make this due diligence work?
Oh, we are working on it. Let me start there on how our process is. Generally speaking, with every deal that we do, we have in-person due diligences as well as desk due diligences. We usually visit the field for about 1 to 2 days, and then we spend the rest of our time at our desks doing all the financial and other types of analyses. It's hard, I will say. Trying to finance, as Justin mentioned, a small deal requires the exact same amount of work that you would do for a much larger ticket size, and that's one of the reasons why we have to also try to be lean, and it's also one of the reasons why, as portfolio managers, we do everything from start to finish. So you know the company really well, and that really helps you with every phase of the deal. That bringing in pre-knowledge from the step before helps you move forward more quickly in the next step. And so we're still working on trying to figure out how to be more lean and how to be more quick. But for now, we still do the full due diligence for every single deal that we do. But the one benefit that we have is we like to work with our partners for a long time. So even though our loans tend to be relatively short term, we work with our partners for 2, 3, 4 loan cycles. So that can be, up to for a really long time until they outgrow us. And we love to see them outgrow us because that means that our debt is helping them grow to the next phase. But having these renewals also helps us cut back down on the amount of due diligence that needs to be done each time because we already know the companies as well. And then going back to our criteria, so as I mentioned before, we do a lot of agriculture, but we also look at water, sanitation, clean energy, and financial service providers. On the company side, we look for companies that have had at least 2 years of operations. And we do require that they have audited statements for at least a year because unfortunately we are not based in region, which means we require certain types of external checks that will help us make our decisions. And we look for companies that have sustainable and scalable sources of revenue of at least $200,000 a year. And finally, of course, impact is very important. So also looking at the types of impact they provide. We have a preference for female-focused and rural-focused companies, but it's not a strong requirement, but they do have to have some sort of positive impact in their communities or in their countries.
Thank you. So for all the entrepreneurs out there to take notes of those criteria. And I really love this idea of that you make an investment, but then you usually think about it as a long-term investment. So it's not just one ticket size, but you're going to be working alongside that company. That's great. Caro, anything you want to add? I think you've talked a bit about the criteria, but how does Biwala does the due diligence to write this small ticket size? Because I think I'm on the tree here, like you're the ones that can write the smallest ticket size, so 50K. And I know you're doing some pretty innovative and different things. So I want to share a bit of how is it that you're able to do this?
Of course. So in terms of our due diligence, Viwala works in 2 different ways. Any ticket underneath 25K, it works exactly as a fintech. Basically, we are connected to the government agency, tax agency, and we just get all the financial information dumped into a technological app. This does all the analysis for us, and we can get a loan proposal between 24 to 48 hours. So it is fairly quickly. Everything is automated. This is for very small ticket sizes, though, that rid us of a lot of due diligence work. For ticket sizes above that, we do start with our technological app. Everything is done automatically. And then we have 2 interviews there fairly quickly, one with the entrepreneur, one with someone from the company who works for them, to understand a little bit deeper the impact side specifically. Impact is something that is very hard to assess only through financials. So that is what we focus our due diligence on. But everything else is just done absolutely automatically. And to go back, just to summarize the type of companies that we're looking for, basically 54% of our portfolio is women-led. So the same as MCE, we have a strong preference for women-led companies. And then the other percentage of our portfolio is social and environmental impact entrepreneurs, where the core of the business is the impact. Therefore, as they grow, the impact has to grow as well.
Awesome. And I just also, I want to pick up one of the questions that we have in the chat. This one is from Diana Deso. which basically says, to add to these questions, what have you seen as key success factors in the companies you invested in? I don't know who wants to jump in on that one. Like, yeah, what are the key success factors of the companies that are able to grow and pay back on time?
I'm happy to start just on a few points. Some of the companies that we've been able to continue partnering with over the years, who are on their second, third, fourth loans with us, I think two key things that I can think of off the top of my head. The first is having a strong management team, having a team that is able to bounce ideas off of each other and be able to support each other and not just be a one-man show has been super helpful, because they're able to take on each other's burdens, and they're able to work with each other to move forward and grow the company. And also just companies that are the founders or management teams who are willing to take advice and willing to learn and willing to grow along with their companies. This type of mentality is super important in a lot of the really successful companies that we've seen. The second thing is sales. Sales is incredibly important. We've seen that especially throughout the pandemic. Companies who are able to diversify their sales and not be dependent on just one buyer or one product or one customer have done better as a whole than companies that are have a lot of concentration on their sales side. Those are the first two that I can think of. Maybe if someone else wants to take a crack at it, I can think of something else later.
Perfect. So we have team, no one-man show, and that it's coachable and open to advice. And then we have sales. Justin, Caro, anything you want to add on success factors of companies?
Yeah, I can jump in as well. I think going towards Carolyn's first point about the team, resilience of the entrepreneurs, specifically during COVID and now with the current economic situation worldwide, I think resilience is a key factor in the success that we've seen entrepreneurs. And the same as sales, having multiple providers for a product, specifically now that we're seeing shortcuts in raw material, et cetera, has also been super important on our end. Justin, I don't know if you want to add anything else.
I agree with everything that's been said. Maybe one thing I would add is I think the vision, the strategic vision and ambition of the entrepreneur is in line with what Carolyn was saying about the management team is really important, and being able to have that mindset of wanting. We see also we operate in small markets, small countries in the Indian region, and often, if the entrepreneur, the difference between the entrepreneur having a national mindset versus a regional mindset, and thinking from the beginning about how the company can scale at the regional level across multiple countries is really important to success.
Great. I think I think Carolyn started with the first top one, but if I just add one, I think also it's really cool, like when you're looking to see of what we call the traction, which is these entrepreneurs being able to transform their ideas into actions and get things doing and just problem solving and get things out there. So yeah, it's a loaded word, traction, but for me mainly it resonates to just being able to do things and try them out and get results. And I think that's also great when you're assessing companies that will really be successful and strive. So cool. And I also before moving on to the part of the sources of capital, I want to address this other question that we have from Tim Hewson. He's asking about the revenue base, how it actually works in practice. And basically his question is, so for the revenue-based loan, does the borrowing firm pay a percentage of revenue until they pay back an amount, or do they pay back a specific percentage of revenue over a specific period of time? So I don't know, Caro, if you want to address this one as how's the Viwala's revenue based? Do they pay back until they reach an amount, or do they pay back during a period of time?
So for revenue-based loans, what we do is we sit with the entrepreneur, we do cash flow projections for the period of time of the loan. Again, this can be between 24 and 36 months. And it's just a standard projection of what they think their cash flow is going to be. We set a percentage of that cash flow that can be between 3 and 10% of the incoming revenue for that period of 24 to 36 months. However, because as we know, different things happened and the cash flow is usually not as what we projected, the percentage that we said, that 3 to 10% stays of the amount of capital you're receiving in terms of revenue. At the end of the loan period, the entrepreneur can choose whether to pay whatever is missing of that loan as a bullet payment, or we can re-strategize, rethink how the loan must look as we move forward, do another cash flow projection, do another revenue-based loan, or a fixed payment loan until the entrepreneur. So again, the key here is flexibility. We think you're going to do a certain way. If your cash flow is higher than what we expected, you'll end up repaying back in a lower period of time, which means your interest rate will be lower. If the economy, COVID, anything happens and you aren't able to reach what we expected for the payback period, then we can strategize and think how we can help you to better restructure that loan for the future. I don't know, Justin, if you have a different approach to revenue-based loans.
Our approach is similar, just with a slightly longer time horizon. We also have set a percent of revenue initially. In our case, we set a multiple that is to say a set amount that the company has to pay back, a fixed amount. But we look for that. We do the underwriting and working with the company on their cash flow and revenue projections. We'd look for that to be a 4 to 5 year period that it takes for the company to arrive at that total amount they have to pay back. If the company grows faster and they get to that total amount sooner, then the loan has a shorter term. And 5 years is the maximum term in our case. And so after 5 years, the company would have to pay a bullet payment for whatever's left to arrive at that total amount. But that being said, as Caro said, flexibility is key, and being able to see when there's an issue and sit down and renegotiate with the entrepreneurs is one of the advantages of revenue-based loans that's really important in our process.
Great. So I hope that makes it clear, but basically you're both saying you both use both ones. So you do have a cap, which is basically like an amount the company has to pay, but you also have like a period that basically the company has to pay back that money in a given period of time. And if the company is not able to pay back in that period of time, you'll sit down with the company and renegotiate and see what's going on. And hopefully you'll do that before the end of the period of time, but during the payment while they're being paid. Thank you. So I also now we're talking a lot about like the actual companies that you invest in, but as Justine, I think, mentioned at the beginning, one of the challenges to providing financing to this type of companies is accessing the capital to being able to provide this type of loans, revenue-based, or even pay for impact. And a couple of you have mentioned like this blended finance type of strategy. So can each one explain like the strategy that they have in terms of access to capital to make sure like what MCE, what Impacto Capital and Ambiguala is doing like works? What's your cap? Because at the end, like investors also have to raise capital for their organizations. So what's your strategy in terms of getting the right capital that you need to be able to do this type of loans and instruments and revenue base for the companies you're working with? And Caroline, I want to give it the floor to you.
Sounds good. So on the capital sourcing side, MCE also has a blended finance model. So we source from a variety of different types of investors. One of the biggest sources for us is actually our own notes. We sell our private notes to high net worth individuals and family offices and foundations, et cetera, primarily in the United States, but also in Europe. And then on top of that, we also borrow from local banks and development finance institutions and other corporations that have ESG type activities. And then aside from the investing side, we also have a group of what we call guarantors. And these guarantors are also individuals or family offices or foundations who commit to guarantee our loans. So for example, if one of our borrowers defaults on our loan and we end up defaulting on our bank, we don't actually, on our investor, we just call on our guarantors to ask them to essentially repay the loan on our behalf. So this is spread across a pool of guarantors. One loan's amount will be spread across a pool of guarantors, and they each write us a check to fulfill the requirements to repay our loans to our investors. So MCE currently does not have a fund structure. We borrow to on-lend, but that's the model we currently use.
Yeah, no, so interesting. So basically, we're saying we need interesting types of capital and different types of capital to be able to do the amazing things that you're doing. Kara, do you want to also explain a bit more about your blended finance instrument and how you're able to do these pay for impact, revenue based, and small ticket size loans?
Of course. So Viwala started with a grant from USAID, and that is how the instrument started to be developed. So usually we work with partners who are able to give us grant funding for what we call the impact lab. So this is the stage where we decide what type of product, what type of interest, etc. And that is usually done through grant funding because there are several iterations of the type of product. Once the product goes to MVP and then to expansion stage, we do so through a blended finance scheme. Usually it has both equity and debt components of it. And the debt part of it is family office, angel investors, and currently we're looking at VC capital, but the range of interest that we try to pay on those debt vehicles that come to us as funding is around 50% Mexican pesos, that is around 8% US dollars. Again, for the pay for impact loans, we look for grant funding. Usually how it works is the entrepreneur receives the loan with our current loan structure. So the debt that comes to us is then granted out in form of a loan to the entrepreneur, and the pay for impact comes from grant funding. So we try to raise capital from equity to debt, anything in between, to be able to create, mix and match the specifics that we need for each vehicle during the MVP phase throughout the expansion phase.
You're saying that you're also using equity, so you're doing the whole range of instruments from equity, debt, and grants. And Justin, how about you? Anything you want to add on this one? Like what is impact to capital, sources of capital to date?
One of the important ones I mentioned earlier, which is the grant funding we have to help us fund part of the operating costs from the Inter-American Development Bank, which is really important. In terms of our investors, we have a group of people who are interested in generating impact in the Andean region or in Latin America in general. One thing that we're really proud of is that we have a majority of our investors are local from the Andean region. So we have investors from 3 countries in the region where we're investing. We also have investors in the U.S. who are interested in the region, whether they be individuals, high net worth individuals, family offices, or foundations. But for us, it was really important to do fundraising in the Andean region and kind of sell this idea of impact investing, which is not very well known among people who have been successful in business in the region, and to try to have them understand the advantages of investing in the amazing opportunities and these amazing entrepreneurs that exist in the region. So we have a good mix of investors in that sense, both geographically and in terms of profile.
Great. And I want to take up one of the first questions that we had from Sebastian Rodriguez, which is basically, he was talking to that, Justin, he was saying, what has the panel seen in ways to catalyze more local or regional financing so we avoid concentrating capital in markets like Brazil, which already have had more advances to capital markets? So yeah, basically the question is, how do we avoid concentrating capital in markets like Brazil in ways of we can catalyze more local or regional financing? So how did you do it, Justin? How were you able to get this local and regional financing for the fund to invest in the Andean region? Because yeah, Caroline was mentioning a lot of UAs. Carolina was also mentioning USAID and so forth. So yeah, how do we get more local and regional financing to the region?
Well, first, just quick numbers on what investing looks like in Latin America. It's venture capital numbers. We don't have the exact numbers for impact investing, but it's very similar. 50% of the capital that's invested in Latin America goes to Brazil. another 30% goes to Mexico. So between two countries, you have 80% of the capital that's being invested in startups in Latin America, and there's over 20 other countries that are splitting that 20%, which really 15 points of that 20% goes to 3 other countries. So there's a huge opportunity to invest in the smaller markets. The capital isn't arriving. What you're seeing now is a lot of the capital that's going to bigger markets like Brazil and Mexico is coming from the US. And I think there's one of the ways we can get more capital to some of the smaller markets is to try to educate and get rid of some of the biases that exist in US investors in terms of focusing on, I think it's more of a problem on the venture capital side than on the impact side, but there's a lot of focus on the bigger markets just because that's what they know, or it's more efficient to open an office there. So that's sort of what we're seeing, and one of the reasons we see a huge opportunity and in region. In terms of local capital specifically, there's a lot of wealth in the region. There's a lot of wealth in the region. What needs to be worked on is the education about the importance of investing in the region, the importance of impact investing and the potential of impact investing. Even philanthropy is just, you have some more and more successful business people and families that are getting into philanthropy, but it's still a lot of the philanthropic money comes from outside the region. So whether it be philanthropy, impact investing, or even honestly traditional investing in the region, there needs to be a change of mindset. And so for us, it's been a long path of building the relationships with local families and individuals and educating them about impact investing and the potential and all the really amazing opportunities there are in the region. And I think we need more people who have that approach and who go through that process and tell the story, and more success cases so that these people can see that there are opportunities. And I think we're starting out that path, and hopefully there'll be more of that in the future.
Anything Caroline or Caro want to add on that one, on how we can make sure we have more local or regional financing?
I'm happy to add a little bit more. From MC's perspective, we're in Mexico, but actually our investments in Mexico are quite small, and they're primarily in more underserved regions within Mexico themselves, the country itself. We focus on the other countries, as you heard from my list earlier. We are in most of Central America, which are all very, very generally speaking, comparatively speaking, very small countries, and we're in 4 other countries in South America. And so from our perspective, we think that our capital is better served in these markets, that are used in these markets, than the really, really big ones. And then in terms of how I think we've seen more funding go into local and regional financing, it's a couple of things. One is establishing partnerships domestically and regionally to make sure that people are connected and are able to access these opportunities in these smaller markets. The other thing I think that is actually incredibly important is guarantees that are provided by nonprofits, foundations, but actually development finance institutions of various governments across the world and also across the region, who are able to guarantee loans or investments of a certain percentage into SMEs in the smaller markets as well. And these I've actually seen globally, and they've been very, very helpful in catalyzing additional investments into these not so concentrated markets. And the one last thing I do want to mention is the US government has been trying to get more private investments into the Northern Triangle in Central America. So that's El Salvador, Honduras, and Guatemala. And so a lot of opportunities will also be coming from that. So yes, the private sector can do a lot, but also the public sector can contribute a lot to adding more catalyzation into these local financing.
Thank you. Caro, anything you want to add to that one in your experience?
I think, yeah, everything that both Justin and Caroline said, we agree with. And specifically what Justin was mentioning about educating the private sector. And that's why we use blended finance to catalyze that private sector through security nets, through security in the investment, but also through education about what the impact investment sector is and what goes beyond just like the revenue they can get from that investment. So going beyond that and starting to monetize impact as a form of return.
Perfect. And I think we had a final question that was repeated is if any of you have plans in establishing an outlet in Africa. Are you having plans to moving borders beyond Latin America? Yes or no? Justin.
We're just getting started in Latin America, so we're focused on the Indian region for the foreseeable future.
Perfect. Caro.
For us, it's more or less the same. We're trying to grow first in Latin America and then expand. However, the LGBTQ portfolio, our principal funder there is already expanding to Africa. So we share most of our lessons learned with similar institutions in Africa, and they're doing LGBTQ growth entrepreneurs in Africa as well.
And Caroline.
MC is actually a global organization, so we invest in, aside from Latin America, we're also in Central Asia, Caucasus, Eastern Europe, Southeast Asia, and of course, Sub-Saharan Africa. So Sub-Saharan Africa actually has our biggest SME portfolio. LATAM is our second largest. And we are, we used to have companies in Ghana. They have matured out of our portfolio, but we are still looking for opportunities in Ghana.
Perfect. Thank you. And thank you everyone for your questions and making this happen. And I just want to leave 30 seconds to each of one of you if you want to provide some final remarks or comments, or if not, I'm happy, I took notes and have some final insights, but I want to leave the opportunity for you if you have any final comments or thoughts you want to share with everyone.
I'll just add one thing, which I think we didn't cover today, which is country risk is a pretty big thing in Latin America, especially in recent years. And, coupled with that, it has been quite difficult to reach the missing middle, especially in these more volatile countries. And we're doing our best, but anyone who is willing to take the risk, we welcome you to join us and contribute and support all these countries and these middle SMEs who are in the missing middle.
Yeah, we didn't have the time. I didn't ask you about Haiti. I imagine it's very hard to operate in an environment like that. So yes. So yeah, no, just wanted to thank all of you for this amazing conversation. The hour really flew to me and everyone in the audience for their comments and questions to make this more insightful. And I just wanted to wrap up with my 4 main highlights that I took from asking questions to you. So basically, the one is just as we all know, providing access to finance in the missing middle, it's really hard. And I think Justin explained it very well in terms of we have the whole challenges that we have in terms of the demand, the country, as Caroline was saying, the companies, the lack of formality, the lack of records, and so forth. And then we also have all the challenge of the supply, getting access to the capital that these companies need in the ticket size, in the right instrument, in the right form that they're needed. So it's really hard. Second, it's amazing that we have companies such as yours, like Impacto Capital, Viwala, MCE, and I know there are many other actors that are joining overall in this week that are doing this type of financing to missing middle and to SMEs. And I think one of the key highlights that you were mentioning here is that it needs to be flexible capital that adjusts to the needs of the investees or the lending. So it's really that lens of really trying to understand what is it that they need and how we can best support them. Third one that I really like, it's you have to be really innovative and flexible in terms of the instrument, and then also in terms of how do you deploy the capital. So how are you doing the due diligence and the assessment of these types of companies to make sure that you can actually deploy the capital. And the last one is access to capital for organizations as yourselves and as Mexico Corp ventures. It is that we need a variety of capital in terms of debt, equity, guarantors, grants, and that we need more conversation and education from private companies, the government, foundations, and so forth, so that we're able to make sure the environment is there and the instruments are there to serve the missing middle. So yeah, if everyone listening, I think you can reach out to any one of us to keep up the conversation and to share experiences and challenges and opportunities to collaborate. So thank you very much, everyone, for joining in.